Hey guys! For a while now I've been wanting to make a video about the economic situation in Greece and how it's basically possible that a large budget deficit over there would cause a lot of trouble in the EU. While doing that though, I kind of realized that you need a lot of economic back theory to kind of understand that and find that interesting. So then I decided to kind of turn this video into a crash course. Basically, all the problems started about a year ago when a new government took seat in Greece. Then it turned out that the budget deficit was actually much higher than the previous government has always told us. It's about 13% of the GDP. While, according to the Growth and Stability Pact that was established when the euro was introduced, it's only allowed to be 3. Greece also has a very large public debt, about 300 billion euros. Because of these two things, two financial supervising institutions decided to lower Greece's credibility rating from an A to a triple B. The credibility rating basically is the chance that a country or a company is not able to pay back its loans. Instead of the state, that would be state obligations they gave out. And the reason this is a bad thing is because investors tend to lose confidence rather quickly. And in order for them to still borrow Greece the money that they need, they would demand quite a higher interest rate. The same goes for Greek banks. If they loan money towards the government, and now the government might not be able to pay them back, 1, they could get into trouble, and 2, they would also raise their interest rates. Then, because the Greek banks might possibly get into trouble, they would also have to pay a higher interest rate towards the European Central Bank. So because this rating is quite involved in the financing of banks, it is possible that both the government and the banks would get in some kind of downward ongoing spiral where the banks would get into trouble, the state would have to bail them out, but for that they would have to loan more money against a higher interest rate, so they would have more trouble paying it back, which would lower then the credibility rating again, which would give the banks more trouble with more money and more interest rates, and then it goes down and down and down. Graphically, that will look a bit like this. So the red line is the demand for money and the purple line is the supply of money. Where these two lines meet, that is the interest rate, because the interest rate is basically the price that you pay to borrow money. So the price kind of determines where lines cross, which is kind of like economics rule number 1. And when there will be less investment because people don't trust the Greek state that much anymore, the supply of money would actually go down. If there is less money available in the whole economy, that means more scarce, so then the price of the money would actually go up, which is also kind of like a basic economic rule, which means that the interest rate would increase. At this point, for example, Greece can borrow money against an interest rate for about 6.5%, whereas Germany or other countries with a really strong economy only pay about 3%. A higher interest rate can also lead to lower exchange rates. These exchange rates are actually determined on the foreign exchange market, which would look a bit like this graphically. The euro rate of return is actually the same as the interest rates within the EMU, because interest rate is not only the money you pay when you borrow money, it's also the money you get paid if you loan your money out to others. That's the orange line. The green line is the expected rate of return in other currencies. I chose the dollar here as an example because, you know, it's a big currency. When investors are less willing to invest their money in Greece or in the EU basically, that means that they will probably invest their money elsewhere where they think is less insecurity. And for example, that could be the US or anything dollar related. So in order to invest in the US, you need to have dollars because that's the currency of the US. So if more people want to invest over there, that means that the demand for dollars would actually go up, which also would mean that the price for dollars goes up. More demand is a higher price, like I just explained. The price of currencies, however, are always relative, because the only way to express a price of a currency is in other currencies. So that would mean that if the price of the dollar goes up, that would mean that the price of the euro would go down. And that's what you see in the graph. This is actually what happened the past few months, and this is also why the rest of Europe is kind of worried about this whole thing, because a lower euro exchange rate doesn't only affect Greece, it affects the entire European Union. The effect of Greece itself is actually not that big because it's a really small economy compared to other EU economies, but people are a little bit scared that this effect might spread, because for example Spain and Portugal are in similar situations, and especially Spain, which is the fourth largest economy of the EU, could cause a lot of trouble. And just because this might happen, investors get even more insecure, and these effects only strengthen the whole process that I just explained. Under a lot of pressures from Brussels, Greece is now trying to make huge cuts in their budget. They tried to cut back their deficit with 10% by 2012, and they actually announced savings and cuts for about 4.8 billion euros. The government seems to be really committed to this, and they really wanted to change things, so that kind of makes the rest of the EU feels a lot better. If this all happens to fail, there is already actually a plan B ready. Plan B basically consists of other banks, especially Germany announced this, is that their banks could sort of buy up all the Greek state obligations, and then the German state would stand surety for those loans, basically. So that Greece would actually have the money they need to solve their issues, and German banks don't have the risk of losing all their money that they invested in Greece. However, if this turns out bad and the German state would actually have to bail out these loans, that would mean that the German taxpayer or other EU taxpayers would actually end up paying for the mess Greece made of its own budget, and that would be rather unfair and unwanted, especially by the people that would end up paying for it. That was a lot of talking I just did. I realized that. I hope I wasn't going too fast and you kind of get the whole thing. If you have more questions, you can ask me. Yeah, I will see you soon on a little lighter topic, I promise.